Testing, testing, 1, 2, 3. All right. Good morning. Good morning. It's good to see a good group of people here already. First thing in the morning, up and bright and early. I was surprised to see you guys all come back. I thought I'd go on vacation, come back, and you guys all be gone. And nobody come back. All right. I'm glad to see so many people here. So that's wonderful. Go ahead and say hello. We'll say hello to a few people. Kirk's great to see you. We got Gary Thomas saying hello. We got Larry McIntosh saying hello. We got Bruce out there saying hello. So it's great to see you guys. We got a few of you in here saying hello. We got a whole bunch more people out there watching. So if you guys want to say hello at some point, I'll make you famous. There's Randy popping in his hello. So it's good to see you guys. Had a good holiday. I went out and went skiing with my boys and had a fantastic time. So really had a good time. It was wonderful, wonderful trip and a good time off. So how'd you guys do yesterday in the markets? I actually traded a little bit yesterday and had a pretty darn good day yesterday. Traveled in the morning, so I didn't trade the morning, but I did get a little trading in, and so I had a couple of good wins. And so, well, one good win, not a couple. Had one good win, and that was good. Good trade, one good trade. It's all it takes, right? One good trade a day. All right, guys, I'm excited to start. I have out on, you saw on the little marquee where out on the marquee where I said we're gonna continue our conversation with the QOCOs and looking at the scalp and trail and how to set up those QOCOs. I had some questions, a couple of emails that came in that said that they were still having problems with the QOCOs and wanted to know if I could help them. So I thought that would be good. We'd continue our conversation there and we'll set up some OCOs. I'll go through it again, try and go a little slower this time. Help you guys set up your scalp and trail in particular was what they were looking for, and explain the concept. So I'll go through that. I know it's a little bit of an advanced strategy, so we'll kind of cover it a little bit. First thing, I don't want to spend a whole lot of time on that because we did spend some time last time, but I will cover it a little bit and we'll go through it again. I do want to do today, we're going to go through, and it is Seasonals Day, right? We decided that the first of the week, that was yesterday. Monday's supposed to be Seasonals Day, but I wasn't here Monday, so we're going to do it today. So we're going to go over and we're going to scan for trade miner things and searches, seasonal trade opportunities. And we're going to do it in the futures market this time. Last time we did it in the stock market. This time we're going to do it in the futures market. So we're going to have fun with that and find some opportunities in the futures market to go trade. But first we want to watch that opening bell. We like to watch the opening bell, and that's going to come up here in, what have we got? A minute and 4 seconds. So in 1 minute and 4 seconds, the bell's going to open. And for those of you who don't know, we got new people coming. My name is Lan Turner, former instructor at the Chicago Mercantile Exchange and the Board of Trades Education Centers, currently an instructor at Utah Tech University. And the reason I kind of started this YouTube channel was to kind of help those students. We go down and we do the academic side of teaching at the university, and then they would like to see practical application. And so I started the YouTube channel. And here we are running the YouTube channel for my university students, the things we learn at class, and everybody, of course, since it's YouTube, everybody's welcome. And we're happy to have everybody here. Anybody can come and join us from anywhere around the whole world, I guess. We got people from all over the world come and check in every now and again. So it's good to have you guys from any part of the world that wants to come and join us here at Utah Tech University and come to the lab. We're happy to have you. And what we're looking at right now, look at that market going already. We got 3 seconds before the bell. It's already taken off. So there's the bell. 1, 2, 3. Let's see what happens. Here we go. So this is the futures market that we're actually looking at. We like to watch the futures market. These are the stock indexes out of New York, right? So this is the Dow up in the upper right-hand corner. Up in the upper left-hand corner, we have the S&P 500. In the bottom right-hand corner, we have the NASDAQ. Bottom left-hand corner, we have the Russell. And we like to watch the very first thing out of the opening bell, watch these things, watch the ponies run and see what they break out and do. Now, we're in the futures market, so this is not the stock market, although these are the stock indexes. We can trade them out of Chicago. So just to switch that little marquee up a little bit and give you a little bit more information about what we're doing here. So again, out of Chicago, we're watching the markets, and we're going to come in here and see if there's not an opportunity. We kind of like to let this first few minutes go by. Don't want to jump into this fray because the market is really crazy. Look at that Dow. It's gone crazy. Let's draw a dollar calculator on there and see how big those bars are. just from the low point to that high peak that happened right there, that was a $280 move. $280 move with if you come over here to the key, you can see in the key that move was requires a 750. We're just going to say an even $1,000 margin. So that can fluctuate, that little number right there, 750 to 1,000. It's usually somewhere around 1,000. I've seen it go up to 1,250 before. Depending on the volatility of the market, your margin will change a little bit. Right now it's saying that it's at 750, but we're going to just say on a round number, it's $1,000. You figure $1,000 investment. And right there, that was a $280 move on a $1,000 investment. All right. So now down here in the bottom right corner, we have the NASDAQ. Let me see if I can make this bigger. And we're going to, I've left W. Crandy on there for a little while. Oh, we got Oliver saying hello too. Hi from Frankfurt. It's nice to see you over here from Frankfurt, Oliver. Glad to have you. Glad to have our international students. That's great. So let me get rid of this banner too. All right. A little bit cleaner screen. So that's what we've got going here. This is, let's come down here. We got a micro mini down here in the bottom right-hand corner. We'll just draw from the top to the bottom where that thing's currently at. That's a $73 move. All right, a $73 move. It's 10 times smaller than the mini. You'll notice up here in the header, it says micro mini. So that's a micro mini. Up here in this header, up here in the Dow, it says mini. It doesn't say micro mini. If we went and got the micro mini and opened up the Dow micro mini, it would be 10 times smaller. That would be a $28 move, not a $280 move. All right. So the micro mini down here on the NASDAQ, that would have been a $730 move, not a $73 move on the mini rather than the micro mini. So we got a little bit of a change up here. Up here in the upper left-hand corner, this is the S&P 500, and this is a 15-minute chart. So we've set that as a little bit longer time frame chart. So each price bar represents 15 minutes, whereas this one is a 1-minute chart. So each price bar represents 1 minute. And then down here, this is the Russell 2000, and it's set to a 1-minute time frame. And you'll notice that it's a mini contract, which again, it's going to be $1,000 investment. And this market has swung through a $385 move from high to low since the morning bell, and that's on a $1,000 investment there as well. So that's a mini contract. Now, if you keep these things overnight, you can't keep them overnight for $1,000. You keep them overnight, then the margin jumps up quite significantly. In fact, you can come over here and look in the key. So, for example, on the Russell, if you keep this thing overnight, it'll go up. Your margin will go all the way up to $7,150. So, if you keep your one contract overnight, $7,150, you have to have that in your account. And then just to day trade it during what we call peak hours between 6:45 a.m. to 2:30 p.m. If you trade during those time frames, then you only need to have, well, it says 0 right now. It's not updating, but you can see over here on this one, it's going to be the same, 750. And then off peak, it's about 2,310. So between 2:30 p.m. and 6:40 a.m., they only make you have to have 2,300. So everything we do over here is in, it's a margin account. So everything is margined from right to the very first entry. All right. So it's a margin account. So that's all you need to have in your account to trade one contract. All right. That's how it works. If you're not sure what I'm talking about, just stick with us, come back. We'll talk about it again, and we'll try and make things a little bit more clear. That's kind of how it works. Just figure you have to have, for one contract, if you go in with the quantity one, for our time frame, what we're doing now, it's a $1,000 investment. All right, we want to look for an opportunity to get in and see if we can't capture one of these moves in the market, and letting it just kind of calm down here a little bit. The first few minutes of the day are a little bit wild and crazy. We like to establish our high and our low. We've established our high right up in here on some of these markets and our lows. So just kind of look for them to be bracketed and see where those brackets are. We've also got the magic blue line in here, which is called the VWAP. It's called the volume weighted average price. And the market likes to go up and touch that. You can see that here on the Russell, it went up and touched it. So this one here tried to go up there, touch it, didn't quite make it. This one's just falling away from it. So the NASDAQ's just kind of falling away right now. It's dropping hard. So the Dow rallied hard out of the opening, and then it's flushing back down. So we'll probably get some sort of what we call a Fibonacci bow tie, where the market starts out here, goes up, comes down, probably turn around and come back, kind of tie off that little bow tie in there, kind of make that type of a little pattern. That's usually what we see in these markets, is they like to rally, flush, and then kind of come back to the starting point. We'll see if that happens today. Sometimes they just, they go up like that and they flush right out the bottom and they just keep right on going. They never do come back. So depending on the news, we haven't looked at the news yet. News is always very important. Let's see if I got my news tab up. So let's come in here and refresh this. So today, March 5th, we've got our news. We had some early morning news, total vehicle sales. Let's see, we don't need all that. Let's come in here just to impact too. All right, 7:45, we had some news. S&P Global Composite PMI final. Purchasing Managers Index is what that PMI stands for. So then we have at 8 o'clock, we've got another news event, ISM Services PMI, Purchasing Managers Index. Let's go in and read that a little bit more about that. The ISM Services PMI for the U.S. jumped 53.4 in January 24 from 50.5 in December, beating forecasts of 52. The reading pointed to the strongest growth in service sector in the 4 months, led up to a new 55 versus 52.8, employment 55 versus 48, and supplier deliveries. Meanwhile, backlogged orders. Finally, services firms are optimistic about the economic due to the potential impact of interest rate cuts. So everybody's expecting interest rate cuts. However, they are cautious due to inflation, associated cost pressures, and ongoing geopolitical conflicts. All right, so they think that they're going to cut interest rates. We got Fed Bar speaking today at 10 a.m. We got Fed Bar speaking again at 1:30. So he's speaking twice today. He's not the one that cuts the interest rates, though. The chair Powell right here, that's a testimony. That doesn't look like he's cutting rates or talking about rates, but here's another testimony down here on Thursday. So we've got a big Fed week. Non-farm payroll coming out on Friday. Holy cow, we got all kinds of big stuff happening every single day. Let's turn that down to 1-3 comp. Look at this. We got Tuesday, Wednesday, Thursday, Friday, next Tuesday. Wow, Tuesday, Thursday. This is going to be a wild couple of weeks. All right, so today, a big move around 8 o'clock. That's what we'll be looking for. That's what we're coming into. There's it looking to be positive. Forecast is 52.9. Consensus is 53. Previous was 53.4. So the forecast is 52.9. Consensus was 53. Forecast is 53.4. Well, that'll be interesting to see what it comes in at. All right, let's jump back over to our platform and see what's going on. Oh, look at that. That Dow just flushed right out of the bottom of that thing. So it went up, turned, and flushed right back down. I'm wondering if it's going to come up and give us that bow tie. We got the Russell running up. I wonder if it'll flush back down. See, we want to get some kind of a smooth pattern in here, something we can trade. Now, you can jump in and start being a little bit crazy if you want to, taking some risks on a return. But these are some big markets. Remember, right here, just from your stop to your entry, that's $110. So if you think that market's going to turn around and start to rally, you could bring your stop up a little closer, right underneath the green, right there. That'd be a $70 risk in anticipation that that market comes back up and tests this level right here. So that's where we'd look for it to come back up and test. And the reason I put that white line right there is because it's the low of this starting point right back in here before the market opened. So I would expect it to come up here. Now, of course, this could also just be an ABC pattern, right? This is what we call a decision point. A decision point. Now, a lot of guys will sell right there. That'll be a sell point right there where it touched. See where it's touched that yellow dot? Let's bring this up full screen. Come on, full screen. Full screen. Where's full screen? So you can see it a little better. See where it touched that yellow dot right there? That would be a sell signal for some guys. They'd put in a sell order and take a short position right there in anticipation of a continuation of the downtrend. So this would be a little ABC pattern. That's why we call it a decision point, because the market has two signals it's giving you right there. One signal is a reversal signal, right? To come back up to that white line. That's what that is. That's a reversal signal. It's our first green candle to make a new high. So that's a reversal signal. But it's also, if you look at our little, where did it go? Here we are. If you look at our little sheet here, cheat sheet, it's also a continuation formation. Now, if you turn that upside down, that's what we got going now. You got multiple green bars, which would be multiple red bars if it was upside the other way. I wonder if I shouldn't draw that upside down to help people see it better. But then you have the pullback bars and then the continuation of the uptrend. That's the ABC pattern that we're always talking about, right? Well, that's would be coming down this way. So we get an A, B, C to the downside. So I'm going to start here, A, B, C, and the first candle to break a new red low would be a sell signal. If you didn't want to take that sell signal up there, a little bit more aggressive, because this thing could, you take a sell signal here and it could keep going up and you'd lose money that way. If you wait and get a sell signal right here, and then if it comes down, tests this low and goes up, you could lose some money. So there's always ways you can lose money, but it depends on whether the market continues through and how confident you are in your direction. That's why I call it a decision point, because it's giving you two signals. It could go either way. Obviously, it can go either way, but they're both signals, right? And the market can always go either way. But the point is, this is either a decision point, meaning are you going to take it long in anticipation of the reversal, or are you going to take it as an ABC in continuation of the downtrend? So if you're going to take it as an ABC to the continuation of the downtrend, we'd take a sell signal, we'd sell one in there, and we put our stop. Generally speaking, we'd put our stop behind one price bar back from your entry bar. So your entry bar is there, but that's $120. Do you want to take $120 risk? If it starts to go back up, it's like, why even risk it? Just put it right in here. And if it doesn't go decisively in your favor, just get back out. There's no reason to sit there. And if it's not a strong market there, we just got stopped out because it didn't prove that it wanted to just keep falling. Came back and broke a new high. It's no longer making lower highs, right? So the definition of an uptrend is higher highs and higher lows. Definition of a downtrend is lower highs and lower lows. Well, we were anticipating it to continue down and make lower highs. Well, it didn't. It just broke a new high, so there's no reason to stay in there and lose more money. So we took a small loss on that one in anticipation that the market might turn and break and continue that A, B, C, D pattern. And it's not doing it, is it? So what it's doing is it's now setting up what we call a follow-up pattern, a second pattern. And the way this one works, so I'll get everything out of here so we can see. So the way this one works is it's now coming into what we call a triangle formation. So it's coming in like this and then like this. And so now we're looking for the breakout. It could either break out up, which would be what we were talking about before, a reversal back up to that white line would be the target, or it could break out the bottom and come back down once again and break out here. Now, in this case, where's your trigger? Well, you could say the first candle to break a new low. If it broke below there, you could get in, but generally we wait for it to break this low right here. So if it breaks that low right there, that's where you could get in. Or you could be aggressive and you could say, well, if it comes up and touches this yellow dot, I'm going to take a short position right there rather than a break to the long side. Normally that would be considered or seen as a break to the long side, but since it comes up there, tests that previous high line, that trend line, you could take a short position up there. That's a more aggressive stance in anticipation of a reversal. So you'd come in here and you'd say, okay, I'm going to go short right there. And then you're like, well, the question is, well, what if it keeps going up a little bit, Lan? Are you going to dollar cost average in and then try and take it back down? Or are you going to just put your stop in there and get out? What are you going to do? Usually we'll allow ourselves $1 cost average. Okay, $1 cost average in this situation. So this is an advanced strategy. If it breaks higher, we're still going to anticipate that it might come up a little bit more and then fall. But we're going to put one in there, and we can put a limit order in there. Maybe we'll put it in here right at this 38,850. If it goes up there, we'll take one more short, but that's it. Only two. That's all we get. And then we got to get out of the market if it goes up and doesn't decisively turn and move in our favor in that way. We just take another haircut, take another loss. But that's a little bit more aggressive strategy, and it's a little bit more advanced, especially when our indicator in here, look at our MACD. This is what we call the call to arms right here. That's indicating this market's getting ready to go back up and probably going to be quite bullish. So you're taking that's why it's an advanced strategy, because you're getting in on a short position against the actual trend. The overall actual trend, the longer term trend is still short, right? But this pullback in here, this little counter trend, you're saying I'm going to try and get in at the top of the counter trend in anticipation of the next drop. So you're trying to get in a little earlier rather than waiting for it to come all the way down here and break this line right here. So that could be an area where you're looking for it to come down and break. There'll be a lot of guys that'll try and get in right there. There'll be guys that'll try to get in right here and break below these low points in anticipation of a continuation of the downtrend. Again, the advanced play is to put it in up here at the top in anticipation of the fall, but you risk the chance that market's going to go up without you. That's why we do the one single dollar cost average. Give ourselves the opportunity to dollar cost average at one time in case we didn't pick the exact top. We generally like to do it right where those yellow dots are. or at least I do. I like to do it right where those yellow dots are. Other guys will have other rules, what makes them decide that they want to take that position. But for me, I like it when it touches those yellow dots. That's where I'll put in my short position. When in reality, that's if it breaks above there and holds above it, it's a buy signal, right? And you'd get a buy signal. So it's kind of a funny place to be putting the order to go short, but that's what you're doing. So now, where would our stop go? Since it's starting to fall, we could put our stop on the yellow dots. So I need it to fall a little bit farther. Still not convinced that it's ready to go. I want to see it break and start making lower lows. Once it starts breaking and making lower lows, then we'll be able to drop our stop in there rather than and get rid of that limit order. Now it looks like it almost broke that low right there, coming out of that triangle wedge formation. Come on, baby. Drop for me. Don't make me look like a fool today. Come on, keep her going, keep her going, keep her going. Okay, it's not playing. It's not playing our game. Making higher lows, lower highs. It's going into a little pennant formation now, another little pennant. This is showing a lot of weakness right here. Problem is we got conflicting signals. We got a signal saying that this market's going to go down. So at this point, you could just say, well, I'm not going to take any loss. If it comes back and stops me out at break even, I'm just going to get out and reassess and try again. It's just showing strength to the upside, weakness to the downside. Come on, you rotten little dog. Should we let it go up and touch our limit and dollar cost average to the short side? Or because if it goes up there, look at this. This MACD is telling us this market's going to go up. That's what that's telling us. That's an up market. Yeah, there it goes. That's disappointing. Yeah, we'll let it do the one limit. We could have stopped out at break even and we would have not been losing any money, but we'll let it do this one here. We'll let it go up and see if we want to touch one more time and then fall. It's giving us a reprieve. It's saying, hey, I'll let you out if you want. You want to get out? Get out at your break-even point? You're bullish. Everything's selling, and I'm going to go up. I'm going to go up. You're going to come in. Which one are you going to do? You going to take the reprieve? Or are you going to dollar cost average? Now you can move your reprieve up. Take one off. Still short one. This MACD is still telling us the market's going to go up. And breaking above this point right here becomes the upside move right there. Man, get out. Why are you long when you should be short? I am short. And he said, why are you short when you should be long? Well, I'm trying to see if it's going to fake everybody out. Try to fake everybody out. I took one off, so I reduced our risk a little bit there. We're not too deep into the red. We're only 47 down, and right now it's sitting at 47 up, so we're cracking break even right now. Are you going to take it off, Len? Are you going to take it off? You always take it off at break even. No, I'm going to see if it's not going to go a little bit farther. Come on, you dog. You rotten little mutt. Just going sideways, dying on us. You know what we're going to do? We're going to go over and look at one of the other indexes, and we're going to be angry as angry birds because those markets over there are probably trending like crazy, and we went myopic on the Dow. And I'll bet you we go over and look at the Russell, and the Russell's going to the moon. And I can't see it because all I got on this monitor over here is the lousy YouTube stuff. And I don't have it down here on this monitor. I got 3 monitors, but I'm only watching one. It's being stupid. Come on, you rotten little machine. You guys know. You guys have more monitors. You can see. I can't see. I can't see what the other markets are doing. Yeah, waiting for the news, aren't they? That's for sure. I think you're right. I think you're right, John. $10 minutes. Might be a good idea to have a position on during the news. We could come and put this in here and put a stop. I don't want to do that. We'll just get out at break even. There we go. Let's go look at what everything else is doing. Oh, they're all kind of, well, the NASDAQ did a lot better, didn't it? On that little counter trend right there, the NASDAQ did exactly what we were looking for. Came down, ABC, dropped again. It's making another one right now. The Dow's still trying to drop here. It's just going too slow for me. I ran out of patience for it. Yeah, there it goes. Even though we had it. We had a short position on there. We could have made more than zero. Could have made more than $50 on it. All right. We got 10 minutes until time to go. Let's go look at our QOCOs. I'll spend just a minute trying to set those up. Let's do that on the NASDAQ. Well, I hate to do it on the NASDAQ because we trade the NASDAQ so seldom. We generally like to trade the Russell. Let's go set it up for the Russell. Now, you say, what? I thought you'd set it up. It'd be for all of them. Well, not necessarily. Some of the markets move in bigger moves. And so sometimes you have to have two sets of the same QOCO orders for different markets. Usually everything works fine on everything except for that damn NASDAQ. So in the NASDAQ, you kind of oftentimes have to have a set of QOCO orders just for the NASDAQ. So you have to be mindful of that because it's such a bigger market. All right, so let's come in here and we're going to do the set the scalp and trail OCOs up. Get our lesson going here. So I'm going to come in here, and last time we did trail and we were playing with all this. So I'm going to remove that. All right, it's gone. What we did last week, it's gone. Okay, so we're going to come in here. Come in here. What we did last week, edit existing, remove, gone. Okay, so we're going to start fresh. Oh, I didn't mean to do that. Oh, well, that was a happy accident. We'll get out of there. So this one here, 1-to-1. We're going to just go gone. Did I do it? Gone? No, I didn't do gone. Okay, remove, gone. Okay, this one here, this is what we did last week. Remember, remove, so it's gone. So we're starting fresh, and we'll go through and we'll start with the trailing stop stuff because that's the part we like the best. And then we can set up the market orders if we want to. But really what we want to do is just focus on two buttons. Let's make it really simple. Scalp and trail. That's all we're going to do, scalp and trail. So let's set up our scalp. The first one I'm going to set scalp up on QOCO3. Why 3? Because QOCO1 is going to be a buy and a sell market orders. So we're going to use those for our market orders, reserve those for market, buy market, sell market. Okay. And then we're going to come down here and we can set those up for scalp and trail as well. We can set up the buys for scalp and trail. And that might be what we got in there. 12 stop, trail, ATR, break even, 24 limit. Those are pretty much scalp and trail settings. Let's come in here and we're going to set up our QOCO. So the way you do that is you right click on the QOCO3. So you right click and you slide down here to add new QOCO3 preset. Now what we're going to do is we're going to come in here, we're going to name it. Now this name doesn't have anything to do with anything other than just remind you what this is. So I like to give my strategies numbers. So if you can come in here and look at the drop down, you can see I've got all these different numbers in here. So I got number 1, which is the one I use the most often. And then I got 2, 3, 4, 5, 6, 7. And you'll notice that if you come in here and the way I do it is I come in here and if you go to number 5, then you go to number 5 here, and then you go to number 5 here, and you go to number 5 here. That's all one strategy. All right. So I have 4 buttons to execute one strategy on. So if I'm going to trade that strategy, then I just set everything to 5, and then I know I'm executing that strategy. But we're going to go to 1. We're going to go to 1. We're going to go to this one. We don't have 1. We'll put it at 1 right now for now, and 1. All right. So that's my number 1 strategy right there. But we're going to set up the scalp and trail. I'm going to show you how to do that. So we're going to set up something new. So let's look and see what number I have available to me. I have 12. Let's make it lucky number 13. So we're going to come in here, add, and I'm just going to give it a number. I'm going to call it number 13. And I'm going to come in here, and this is going to be a stop. And I could say it's a scalp and trail, but I'm going to write it in here so we can tell us what we're actually doing. What we're going to do is we're going to have a stop order, and it's going to have we're going to put a stop on it. So it's going to stop entry, and we're going to, what are we going to do? We're going to trail for entry. Trail. How do I usually write that? Now I forgot. Let me go look and see how I've been wording this. Stop trail. Okay. So we got stop trail ATR. Okay. So let's write it like that. So I'm consistent. So this is number 13. and we're going to say stop, trail. And what do we want to trail for entry on? One price bar back or the ATR? We're going to do the ATR for this example. Okay, stop, trail, ATR. And then we're going to put a stop limit. That's a stop trail. And then we're going to stop us out if we're wrong. Stop. And we're going to put that at what? How far back do we want to put our stop? Let's start it at, I think we were looking last week, we're looking at 20, 10, 10, 15. Can't remember. Let's go halfway in between. Let's go 15 for now. And then we'll come back and we'll adjust it. And then we'll put our limit, because this is the scalp. This is the scalp. So we're going to put our limit at, if we're going to do 15, we have to do a risk versus reward ratio of 1 to 2. So we're going to put out 30. All right. So we're only going to risk 15 to make 30. And then we're going to make that our default. And then we have to come down here and set this all up for what we just wrote up there. So we wrote that we're going to have a stop trail. So our order is going to be right here, a stop. So this is your entry. See this section up here? That's for your entry. And I think this is where people got confused. This stop up here is not your stop for exit. This is your stop for entry. How can you have a stop for entry? Well, you can have an open stop, and if the market hits it, then it becomes a market order, which executes an entry position, right? So stop just means at this price. The thing is that we can have the stop trail. We can have it move. So that's what this is. So your stop. So let's come in here. Let's go ahead and I'm going to save that, number 13. I can show you. So you can come in and have a stop, and it's going to drop your stop. And a stop can be either above the market or below the market. Once you drop it, you have to leave it on the side. So we're going to drop it in here, move it up and down. So notice that above it, it's a buy stop. Below it, it's a sell stop. So that's the important point to remember. It's above it, it's a buy stop. Below it, it's a sell stop. Now, limit orders are just the opposite. Notice this is a sell stop, and it's below the market, and it's red. If I put a limit order below the market, it becomes a buy limit order below the market. So the market would come down, touch it, and buy the market, and then go back up to make money. So that's the difference between a limit and a stop. Remember, they're just the opposite. And so we're going to use stops because stops can trail. We can make stops move. We can't make limits move. They have to just, once you put them in there, they're just a target, and they just, like for example, if you think the market's going to go down, you could sell, you get into the market. Now you're short. You put a limit down here. That's a target to take you out, and you get the money between where you got in and where you got out. So that would be a $115 move, right? So that's the idea of a limit order. So what we're going to do now is we're going to come in, we're going to use a stop order. Now, if you put a stop order, okay, it's not filled. That doesn't cost you any money. And it sits there. There's no commissions on that because it's an open stop, meaning if the market goes through that price, it will then pick up a position to the upside. And if that's confusing, think about it the other way. Like that. If it goes up and goes through that price, that green line, well, we'll anticipate it continuing to go up, right? So it's going to go up. It's going to hit that green line, pick up our order on the way through, and it's going to keep going. So that's what we're going to do with this one. So we're going to set up and that didn't cost me any money, and it's not making or losing money until it's filled. But we can make it move. So what if we put it in up here and we want it to come down, and if this market's continuing to fall down like this, and we want it to go with those yellow dots, so when it intercepts and goes across those yellow dots, we want it to, right? We want it to go up. So we can actually tell it to do that. We can come in here and we can say, okay, I'm going to edit the order, and I want it to trail the ATR dots, which are those little yellow dots right there. I hit okay. Now it's going to move to, and the computer is going to move it every time you get a new yellow dot. The computer will move that stop order closer to the market. It'll follow it all the way down until it reverses and goes the other way. So that's an automated order now. It's moving on its own. So that's what we're doing with the QOCOs. We're going to set up these automated systems to move on its own. Man, look at that slippage. That was a big gap right there. Oh well, that was our news event. So that was a happy accident right there. Let's put this in here and just put a stop in at break even and let it go. See where it goes. Probably go up, test this high, turn around. You could scalp out your $100 right there before it comes back and stops us out. Take a little bit of money off. We only went in with one, so we can't scalp and trail. Now we got $20. There's a previous high. If it holds above that, they must like the news. I thought it might flush back down, just stop us out at break even. Watch the little chart up there if you want to trade this. See when you can get back in. You turn off your Heikin-Ashi and see what it's doing. What are the other markets doing? Let's go look. So they're all breaking higher across those yellow dots. What's our news say? They come in with the numbers. Here they go. Actual numbers, 52. So forecast was 52.9, consensus 53, previous was 53.4, came in at 52.6. That's worse. Everything's worse. Worse than the previous. Worse than the consensus and worse than the forecast. And it goes up. That is a perfect example of what I tell you guys all the time. Don't look at the numbers and try and determine whether that's going to make the market go up or down, because you never know. It's just going to move the market. And you think you know that, oh, that's good. That's bad news. The market should fall. No, this market goes up. So that's a perfect example of what I'm always telling people. Oliver's saying we should go over and take a look at gold. I got a little gold. I bought some the other day. Well, here it goes. So this is the one we were looking at. It broke above that high. Should have kept our position, huh? Should have just put my stop at break even and let it go. I always live and learn, Lan. You're always too quick to pull the trigger. So we got our little up, our little down. In hindsight, it looks like, oh, that was as obvious as the nose on my face. Okay, so let's get back to our lesson so we can get in here and start to trade. All right, we've got 4 bars. What we're going to look for now is we're going to look for a little pullback. Let's see if we can't get a little red bar pullback in here, 4 or 5 bars, and then look for the next rally up. Okay, we want to get our orders set up so that we can trade this. So we're going to come back to 13. So the idea here is that we're going to set this up. That's our stop, and we're going to make that thing move, right? And we said that we're going to set the stop back 15 ticks, and 15 times 5 is how much money that is. So 50, 60, 70, 75 bucks or something like that. So we're in here, the attached limit, we're going to go at 30. And then we're going to tell it to trail for entry on the ATR. That's it. That's all we have to do to get into the market. That's setting up our stop. Now, this is the scalp part of it. This is the scalp and trail. So we're going to say this is our scalp out of our scalp and trail strategy. And then we're going to set up the limit order to take our profits. So now we have to come down here and we have to say, oh, wait, that was the, I'm sorry, stop entry. Attach stop. Oh, okay, right there. So that's our limit. Now we're going to say, what are we going to trail? So we're going to have our stop. We don't have to have it stop. We can just let it stay there. But I like to come in and tell the stop to follow up behind the market ATR. Now we can have it just go to break even, trail to break even, since this is our scalp part of our scalp and trail. So we're going to drop it at 15. It's going to jump to the ATR and trail up to break even. That's all our scalp strategy is going to do. This is the 30. So it's going to set a limit out there at 30. And then if it hits that, takes the profits, it's done. All right. So I think that one's set. If I got a mistake in there, we'll find out next time we try it. So let's go and save that one. Now let's set up our trail side. Now we're going to come in here and it's number 13. So we're going to add number 13 in here and we're going to say number 13 and it's going to be stop trail. And we're going to do the same thing, ATR. And we're going to put the stop in here at 15, same stop location. Everything's going to be the same for the trail. And we're going to put the, this is where we leave the, let's try and see if it'll let us do that. We're going to leave a limit. Yeah, I think we can do that. Limit at 0. Okay. Limit 0. And so that's going to be the trail. So now let's make that our default. And we're going to come in here and we're going to put that as stop. And our stop, we said we're going to put it back 15. And our limit is going to be 0, meaning we're not going to have one. We're not going to take a profit because the trailing stop is going to just trail all the way up. And we're going to have it trail for entry, we said on the ATR, right? For that's entry's trail. And then the exit trail is also going to be ATR. So we're going to trail for entry, trail for exit on the ATR. Okay, and we're not going to put until break even because we want this one to trail us to exit. So this is our scalp and trail. So now that's it. So now we come in here. Okay, we're getting our little pullback in here. Now, the problem is that we also need to have the same setup for price bars back, because if it doesn't break the ATR, we don't have an ATR dot to set it on for the next leg up. That's why you see me have do 2 in here. I have one for the ATR and I have one for the price bars back. And sometimes I'll just do I'll set it up. You can do it but then you don't have your buy markets in here. Then you have to drop down here and go like this. And you have to move in between. So this one here, you'll see is stop reversal. That's on price bars back. So if I wanted to drop it on price bars back, it's going to take the first candle to break a new high on the price bar back. The one we just set up is for ATR. So it only does the ATR. That's why you need to have these little drop downs to let you set up different strategies. Now there's the advanced strategy. Once again, you think it's bullish, you would buy right there as it touches that yellow dot. Right there would be a buy signal. You could buy it right there. Or you could wait for it to break and be the first candle to break a new high and get in right here. That's what we're doing. Because if you buy right there and it does like it did last time for us and just kind of kept going down, then you take a loss at that point. You still have to put a stop in there. You have to just decide whether you're going to dollar cost average one time or not. So the way this is, see how it just jumped for us automatically? We're still doing the Russell. So we could buy right there in anticipation of this thing now turning around and going back up from that point. But that's dangerous, right? Because it could just keep coming down. And that was bad news. So it might just have flushed up and do one of these things. Of course, it's not going to come straight down. It'll probably come down, do one of these, fake everybody out, make them think it's going to go up here, and then it'll turn and fall here. There's just all the things that the market can do to trick you. Remember, the job of the market is to trick you into get into the market just before it goes the other way. that's the way it feels. I'm going to trick you into going one direction, and then I'm going to go the other. So it's all trickery. See that? Good thing we didn't take our advanced position right there and take a long right there. A lot of guys did, I can tell you, because that's a real popular thing right there. A lot of guys went long right there. Now we're seeing, read the volume. So you got big ups. The volume is dropping on the pullback. That's weakness, meaning that we should see it unless more buyers step in. Now we started getting a little increase in volume coming down. Okay, so we can do it like this now. Let's exit out of here because the price bars back thing for the long side failed on us. So we could come in here and use our new number 13. So let's put this back to number 13. And this is our scalp and trail. So how would we do that? We're going to come in here. We're going to click on that. We're going to drop it to the upside above. We have to go above the ATR dot. See that little ATR dot? Because we're going to trail down on the ATR dot and we want a reversal, that would catch the reversal going this way. Cross over those little dots. We need it to trail down on those dots for entry to the long side. That's what we're doing. All right. So we're going to come in here. We're going to drop this in. We got to be above the dots. If you put it below the dots, it becomes a contingency order, and then the dots have to catch up to it. We're just going to have it capture the dots. Now that's our scalp. That's pretty close. That's a pretty close stop. That stop might be a little too close, especially how big the market's moving right now. So let's come in here, go to 13, edit 13. Let's make that stop a little bit bigger. Let's go to 20. If we do that, then we have to make this 40 to keep with our risk versus reward ratio of 1 to 2, right? So we're going to make this 20. We got to make that 40. So 20 and 40 is our new numbers. Okay. So now we're going to come in. We're going to drop that in there. That's our scalp. Let's do the same thing for 13 here. So we're going to make that 20 and 40. 20 and 0. I'm going to change that stop to 20. All right. And then we're going to drop the same thing right up here. So what that's going to do is it's going to fill us if it crosses those yellow dots to the long side. People are always telling me, just trade the dots, Land. Just trade the flip over time. Okay, we'll do that. That's what this is going to do. And then it's going to go up and it's going to take our first scalp off. It looks like as it tests that high right there, which is a good spot. Don't want it to have to break through that high to get to that scalp. We want it to stay inside that high right there. So if we draw a line across there, that's where you want that scalp to be. You want that scalp to be inside that white line. If that scalp ends up on the outside of that white line, that's not good. That means the market didn't pull back far enough. But if it doesn't, if it's way out here, that means the market just pulled down and then it's turning and going to go up strong. You'd probably do that with your price bars back rather than with your ATR. Okay. We can set the same thing up to do price bars back because we're using Heikin-Ashi. So Heikin-Ashi already has a smoothing component in it, very similar to the ATR. And that's what makes the price bars have these beautiful lower high flat tops. All right. And lower and higher low flat bottoms. That's ATR. Or that's the Heikin-Ashi. So we've already got that built in. We don't even have to use ATR if we don't want to because we're using Heikin-Ashi. This is just kind of a double smoothing component that you can use. Okay, so the market came all the way back down to the blue line. Magic blue line is just like, it's like a magnet, and it pulls the market back to it all the time. So we came back to the magic blue line, and now it's trying to break away from it again. It's trying to break out. Let's see if it'll break and go higher. If it does, we'll try and scalp and trail. If it breaks lower, that's a little pullback on the counter trend. So this is where the bad news was. So it's bad news bears. Comes in here, goes up here, gets a little bit, and then drops like that out of the bad news. Which if you wanted to take that short position, you would do the scalp and trail, only you would use the tools to trail the one price bar back, right? But man, it came right back down here and died. The price bar's gotten so tiny. It's not doing anything. Let's pull up our MACD and see what MACD. Let's turn off the CMF. Look at MACD. MACD's on the backside. So that's saying that we should probably get a continuation of the downtrend down into here a little bit. So that's saying we should see it come down a little bit more. So we'll just continue to trail on with our scalp and trail. We got both the scalp and trail on there, which means we got two orders. Notice how I put that in there. Let's exit that off. What I did is I dropped both of them, one of each. That's how I get two to the long side. I got one of each. This is my scalp, and this is my trail. If I do the trail alone, exit chart. If I do just the trail, that's what it looks like. It's got the order for entry, and there's no limit order. It's just the trailing stop. Right? And I've probably got them still a little bit too close. 20 might be too close. That market, if it didn't just immediately go in your favor, it'd come back and stop you out real quick. But that's kind of the way I like it. I like it to just immediately go in my favor. And if it doesn't, if it hesitates at that point, I don't usually want to be in. So I want to drop both of them on there, a scalp and a trail. You got to get them in there fast sometimes. Try and give yourself a little extra time. There we go. Okay, so we filled long with two, right? One of them we're going to now scalp at our profit potential here, which is $197. You don't have to have it that far away. We're trying to do 2-to-1 risk versus reward ratio, though. So we're going to risk 100 to make 200, basically. Risk 50 to make, oh, that would be both of them. That's just one. That's a single. That's quantity one. Maybe we got that a little bit too close. How much are we going to risk? Come on, you rotten dog. Go up there. So it went up, hit those yellow dots. Remember, a lot of guys will sell right there. When it hits those yellow dots, that's a sell signal for guys who think this market's going to turn and fall. We're taking it long. We're trying to catch the crossover of the yellow dots as the market turns and retraces and go back up. That was the decision we made. This is, again, this is a decision point right here. Decision point. Is the market going to go up or down? And if you think it's going to continue down in this downtrend, this is just a little counter trend, you need to start looking to buy as it pops up back up against these these high points. So you'd buy right there. We're saying, okay, our decision point was we think it's going to turn and go this way. It's going to go up, pull back, bounce off that blue light, and continue to rally. Now, the worst thing it can do is do neither one. Just sit there and wander sideways and bang you back and forth and take your money away. So we're going to see who made the right decision. I don't think our limit needs to be that far out. Well, I guess it does. No. Yeah, because we're gonna risk 2 to 1. We get stopped out. We're gonna lose $100. A rotten thing. So the advanced guys got us that time. They got in short right there, and now they're pushing the market down. So that's your scalp and trailed the long side. We trailed those yellow dots, and that didn't work out for us. Came back up. Everybody got in right there on those yellow dots to the short side, and down it flushed. Now the question is it going to continue to flush? We have bad news, so it should. So this is down, up, down, right? That's how the scalp and trail works. So now we got the dots are up there again. You could do it again. I want to try just one. How have we got this set? Risk 100 for 200. So yeah, we do have 100 to 200. And so if you're going to risk 100, you're going to do 200. That's just how big the market is right now. Moving some big moves. You come back here when it's quiet, you don't have to risk quite. Usually I risk about 50 to 60 bucks on the Russell. I don't generally have to risk 100. But this market's moving pretty big bars. Those are big moves. Each one of those bars, look at how big those bars are. Those are $260 bars. Those are bigger than the morning bell. So you may have to adjust that, decide if that's how big you want those. Okay, so we're trailing. This is our scalp. So risk 100 to make 200. If you don't want it to be quite that big, when the market calms down, we come back at 9 or 10 o'clock or 11 o'clock, the market won't be this crazy. You probably won't have to risk that much. So you can come in and you can turn this down. So come to 13, and you could probably tamper that down a little. Might be able to maybe go to 15. 15, that would make this 30. But where the market's going crazy like this, I don't know if you want to do that. 15 and 30. Ooh, look at it drop. Those guys that took it right there, that advanced strategy for the downside, that'd have been a good payoff. So it rallied up on the news. On the bad news, it rallied up, came down, made a counter trend, tried to go back up again. This is a little profit taking in here. See how choppy it is. But it's profit taking from the guys who got in short here. So a little profit taking and then dropping again. So if we wanted to put on our scalp and trail, we'd have to, the way we got it set up, we have to use these dots. So the dots are behind it still, going this way. So this strategy is to catch a reversal, go the other way. It's like, every time you look in hindsight, you're like, why don't you just get in when it crossed the yellow dots right there? Why didn't you just get in when it crossed the yellow dots right there? It crossed the yellow dots. Why don't you just get in? Why don't you just get in when it crosses the yellow dots? Why don't you just get in when it crosses the yellow dots? Okay, well, that's what we just set up. So we come in here, scalp. So it's going to jump and it's going to cross the yellow dots and scalp. And then this one will be trail. So then this one will trail up to, and then just continue to trail the yellow dots up, however far it goes. So that's your scalp and trail on the ATR. Now we go through and do the exact same thing, scalp and trail, and set it all up on price bars back. Again, because we got the Heikin-Ashi in here, the Heikin-Ashi bars. We can just scalp and trail based on the Heikin-Ashi highs and lows. And then you could also set up your buy market, sell market to do that same thing. So you could just say, oh, I missed it. I want to get into this. You hit buy market. It automatically sets your stop, sets your limit, and then will automatically trail. So you can do that as well. We can set those automated up. And then in the interest of time, I won't do that today because we've already spent all of our time doing 3 and 4. And the market's getting away from us, going the wrong direction. All right. So again, remember that advanced strategy. If you guys want to play it, it's when this market comes back on these counter trends, touches these yellow dots where you think you're going to take a long position and go this way. A lot of guys will get in right there, and that's where they take their positions. I like to do it. I do it all the time. I take these counter trends, and when it comes up and touches those yellow dots, take a short position. I'll allow myself to dollar cost average one time, depending on what the MACD is looking at. If the MACD is on the backside and we're looking like it's going to continue down, I'll allow myself to dollar cost average one in case I didn't catch just the right high. But if it's coming down and going the other direction, like it was in our last example, I don't like to do the second dollar cost average because that's the call to arms to the long side, right? So we don't want to do that. So read your MACD if you're gonna do that advanced strategy. Hopefully that's helpful. I should probably write that up in a slide for us. Got all of our slides up in here. Oh, this is the software I'm using. I'm using Track and Trade. If you guys want to use Track and Trade like I use and go get your software and come over here and join us, then you can use Track and Trade. Also, scammers. Remember, I'm not ending the video right now. This happened to be on the screen when I pulled it up. Scammers, don't fall for it. I will never call you on the phone. I will never ask you to trade your money. I will never contact you with cryptocurrency recommendations. There's guys out there acting like me, and they're doing that. All right. So I can't remember why I was going to pull that up. Look at that. Nice little move. Hindsight, you look at that and you're like, I should be rich beyond my wildest dreams. If I could just master this. 1, 2, 3, 4, 5. Just one up for every down. One up for every down. One up for every down. Up, down, up, down, up, down, up, down. It's one up for every down. When you get a trend, we usually get 3 drives. We call it 3-drive pattern. Drive 1, drive 2, drive 3. It's just another recurring pattern, just like a triangle, wedge, anything else. Generally get those 3 moves. Usually the second one is the biggest. So that's usually the biggest. It's about the same size as the first one. Third one's usually the smallest. So if it breaks and comes back out again, okay, once more, here's your advanced signal. If that thing comes up, we got drive 1, drive 2, anticipate drive 3. You got a decision point right here. If that thing comes back up in there, are you going to take a long position in anticipation of a reversal? Or are you going to get in there and take a short position in anticipation of a continuation of the downtrend for the third drive? There's no decision points right in here. These are not decision points. This is not a decision point. This is not a decision point. These decisions have already been made. The decisions come at these breaking points right here where you change colors from red to green. Red to green, that's a decision point. That's actually a decision point right there. Right? That's a decision point. There's a decision point. There's a decision point. There's a decision point. These are your decision points. Well, actually, that's not one right there. That's a little decision point right there. Ugly one, but it was. And then it burst out. That was the news event. So remember, each decision point comes when you go from when you're using Heikin-Ashi, the decision points are yellow to red. So the decision point here is drive 1 down, counter trend, drive 2 down, counter trend, drive 3 down. See if it'll continue. Want it to break below this low right here. We could put in our scalp and trail, add OCO. You can come in here, you can do the scalp and trail manually. So this one here would trail on the ATR. And we're risking $95, $100. So we need to scalp about $100 out of there. $100 would be right about right there somewhere close. So if it comes down there, that would be your scalp. Now we're not doing a trail. You could say, I want to stay in longer. Okay, well, that would be a scalp. That wouldn't be the scalp side. That would just be the trail side. So you say, well, I want to leave that in there longer. Well, that means you think the market's going to come down farther. So you could do this trail side of the scalp and trail. Right? Or you could put this in here and just scalp out your $100. Oh, that would have to, since we're risking 95 right now, we'd have to have this at 200. Risk 100 to make 200. But Lan, what if I want to risk 100 to make 100? Well, you could do that. And if you do that and you're 50% right, you'd lose as much as you would make, and you would actually lose money because your commissions would come out of that and you'd have to pay your commissions. So you'd make as much as you'd lose in the intrinsic value, and your extrinsic intrinsic value, and your extrinsic loss would be the commissions, and you'd lose your commissions. So you kind of want to make more than the risk. Okay, the risk now is at $65. If you wanted to adjust that, you can. You've moved your stop in. So you can say, I'm risking 65. It goes back and stops me out, I'll lose 65. So that's 120. If you want to bring this in, technically speaking, you could say, well, I'm at 120 now, so I could put that right there and scalp out 120 because I'm risking 65. Actually, it'd be a little bit more now. It's 170. That's close enough right there. Right there at that 2060 even number. Come down there, we could take our profits. Now, this is a 1 minute chart, so we're going to get a new dot every minute. There, we got a new dot. And that went 45. So if you wanted to, you could bring that up to $90. Because you're starting to lose our momentum, our mojo. It's coming back to break even. If it goes to break even, generally I just get out because I don't want to lose any money. But you got your stop there. Why are you using a stop if you just get out at break even? Good question. Because I hate to lose money. I want a market to decisively move in my favor. Once I get in, I want it to go. I don't want it to sit here and do that stupid, oh, I don't know, I'm tired. I might come back a little bit. Oh, I don't know. I just want it to go. And if it breaks a previous high, I just get out. Or if it comes back to my entry point, just get out. Quit losing money. That's the name of the game. Quit losing money. There's always 100,000. The problem with this game is that there's too many buy opportunities. See, that third drive died on us. Told you, third drive's not is usually the weakest one. Drive 1, drive 2, and little tiny drive 3, and it died. Okay, we could put in our scalp and trail. Crosses those yellow dots. Did I get that next one? Oh, it didn't. I didn't get it in there in time. So we're only scalping. So we got the scalp that crossed the, so that's our number 13, QOCL3 to the long side. I was going to do seasonals. We spent too much time doing QOCOs again. That's why I was going over to that screen. I was trying to find my seasonal stuff. I got distracted by scammers. Okay, so that scalp is right at the blue line. So if it'll go up and test the blue line, we'll scalp out $145. We're risking $80. We're currently up $50. You can see that right over here on this left-hand side. Sometimes the chart gets in the way, but there's those numbers. So there's where we're at. You can see that. 145 is where our limit's sitting. That'd be 145 in profit. You can adjust these. These are user definable. That's just the way I have them set. So this is saying we're up $30 and we're risking $80. So if it comes back and hits our stop, we'll have to get out with $80. See, it's being wimpy. Come on, you wimpy market. Just get in when it crosses the yellow dots, Lan. Why don't you just get in when it crosses the yellow dots? Okay, let's do that. Sometimes it crosses those yellow dots and turns around, comes back, spikes the other yellow dot on the other side, doesn't get you out, or doesn't break the yellow dots. It just sends its little spiky thingy down there, takes out your stop, and then turns and goes without you. I hate it when it does that. That's what this is. See, right here. If you look at it, you think, oh, that would have been easy. Why don't you just get in right there? Because you get in right there, and your stop is on the yellow dot. It came back, stopped you out right there from your entry right here to the short side. From there to there. See, it's doing it again. Get you in here, comes back, stops you out right there. Question is it going to go or is it going to drop here? The market's not being strong enough to move anything now. It's being lazy. Buy right there, Len. That's your advanced strategy. Buy when it touches that dot. Well, we were in and that's where we got out. That's why it comes back there and touches it, because that's where everybody's got their stops. Look, we're at the call to arms down here on the MACD. That's saying we should be going long. Well, go in then. Put it in. That's the advanced strategy. See if we can't. This market's doing nothing. Come on, you tired, lazy thing. You can't call it tired and lazy. It's been doing good trends. They're just not long enough. It's just not. 3 bars does not make a trend. Anything under 4 bars is not a trend. 4 bars is barely a trend. It's the beginning of the trend. It's the first leg of the trend. $10. Now that's a trend. Look, it's coming back on us again. You piece of crap. It's going to be so obvious in hindsight. Len, it's going to be so obvious. It's going to go up, make the counter trend, and it's going to turn and fall, and you should have just taken a short position right there, and down it's going to go. And here you are trying to go long. You're even doubling down as the market's turning and coming down again. It's going to make another downtrend. We had bad news, Len. Why are you trying to go long? Not trying to go long. Just trying to go the direction the market's going. And it was going up. Now it's going down. This is our advanced strategy. This is what I tell you. This is advanced. Be careful with this one because this one rips your hiney off sometimes. You think it's going to come up, spike those yellow dots, and turn and continue in the trend, which sometimes it does. But if it doesn't, it's like you're going against the trend. That's why I like to buy on a break above a previous high or sell on a break below a previous low and not go in the opposite direction. This is where you start. This is where people get in trouble because now they'll come in here and go, oh, dollar cost average again. Oh, I'll dollar cost average again. Oh, I'll dollar cost average again. They start building themselves a pyramid and they start doing what I call the Christmas tree in anticipation that the market comes down and turns at some point and goes back up and starts making the money. And that's where you lose your account. You do that and then you're like, oh shit. And then what happens when the market just does this? And then it never does turn around and go back. And then in about 1 hour when it's over here, you decide you can't stay in it any longer. And so you get out and you lose all of your account. And then that's where the market turns and goes back up. Ask me how I know. It's not a good idea. This was not a good idea. Come on, you're supposed to go do seasonals. I don't think we're going to have time to do seasonals. And look, our little call to arms has died on us. So now it just died on our call to arms, goes short again. Okay, sometimes it'll give you a reprieve and you're like, oh crap. So what I do is sometimes if I get nervous like this, I come back and I put my limit in there and take 2 off, take 1 off, and it comes back, gives you your reprieve. And sometimes then the problem with that is then sometimes it turns and goes and you took your 2 off as for the reprieve to try and reduce your risk. And you could have had 3 to go the other direction. But sometimes it works out for you, comes up, gives you a reprieve, and then now you're only short with 1 and it comes back down and you can dollar cost average a little bit further into the nasty. Okay, so we got our reprieve. So now we're only long 1. So at that point, if it takes off and goes, you only have 1. That's the bad thing about taking the reprieve. The good thing about taking the reprieve is if it now turns and continues to fall, you only have 1 and you could continue your nasty dollar cost average down if you wanted to. What the heck? 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 Okay. There's our trail. That's our scalp, right? Scalp. So if we cross the yellow dots in anticipation of a continuation of the uptrend, that would be our scalp. We'd get in, take one off right here. Oh, wait, we got quantity 2. We don't want to do 2. Kill that. We only want to go in with 1. Make sure you got your quantities right. So we'd be adding 1 into our long position if it breaks those yellow dots. Okay, now we're long 2. So we're long 2. We got our scalp and trail. This is our scalp. So we got sell quantity 1. We're long 2. The other one we would anticipate going to the moon, right? Go to the moon, baby. Go to the moon. So we take our stop now because we got a single in here. We have to protect ourselves. Now, if you come in here and drop a single in here and say, I'm going to put my stop and edit, and I'm going to trail my stop 1 price bar back. Let's go 1.1. So the 0.1 is to cover the spread. If we do that, we can't come in here and say trail to break even. It doesn't let you do that. Oh, just stop this out. This market's not going anywhere. If you could just get it to break even, you wipe the sweat off your brow and let the market go as long as it wants to go. But it's not going to do anything. All these little trigger points, there's nothing giving us anything. All right, guys. Well, hopefully we learned something about QOCOs again today. Hopefully that was a little bit better lesson. Hopefully we got a little bit more experience today. That was all about, trying to get you a little bit more experience, just seeing what's going on, using the tools. We'll come back at 9 o'clock, 10 o'clock, 11 o'clock and see what these markets do. All right. Go in now. Your assignment, your homework assignment is to come in here and set up the 1 price bar back QOCOs. I showed you how to do it on the ATR. Now your job is to come in here and set it up on the 1 price bar back. Now, if you want to, you can skip the buy markets altogether and just use this buy market button up here if you're going to do buy market. And then you have to do everything manually. But if you wanted to, you could set up the top one. QOCO1 could be your trail 1 price bar back. And then this one could be so that would be your scalp and your trail 1 price bar back. And then this one would be your scalp and your trail for ATR back. So you could have a choice and you wouldn't have to sit there and worry about the drop downs. You could have QOCO1 could be 1 price bar back and scalp. QOCO2 would be 1 price bar back trail. QOCO3 would be 1 price bar back. No. QOCO3 would be ATR scalp and QOCO4 would be ATR trail. All right. So then you could use the color coding, higher highs and higher lows of the price bars, or you could use the ATR, whichever works best for you. And whatever the setup is, you could choose which one you want to do. All right, guys. Yeah, Michael Bruce is absolutely right. I like your new picture, Michael. Catching a falling knife. That's what that is. Market's coming down. That's the Christmas tree catching a falling knife. Oliver, thank you. Hope that worked out for you. So Oliver says he's got it now figured out. So he's going to go and now I want you to go do your own. Go set up your own QOCOs the way you want them. Great. Glad Kirk enjoyed it too. So this is helpful to some people. So John David Lumberg. All right, guys. All right, Bruce, you bet. I'm glad you guys have had a good meeting, good lesson, and we will. Oh, I got a Sunday school lesson for you. Don't run off. I got to give you your Sunday school lesson. Education is the key to your success. Did I already do this Sunday school lesson? Seems like I did this one. Even Tiger Woods has a coach. Education is the best investment you can make in your trading career. You wouldn't think twice about flying an airplane without instruction, but people risk their life savings without instruction all the time. Don't be that guy. I don't have to say that to you guys. That's why you're here. So I'm preaching to the choir. So congratulations on doing the right thing, getting some education, learning how all this stuff works. And if you guys want to be kind and give me a little thumbs up today, then do that. And also click that little subscribe for those of you who haven't subscribed yet. And we will catch you guys tomorrow. Same time, same place.